Okay, our topic for today is the terms of trade. And as it says there, just in the title itself, well, the terms are the values you set for trade. So, if you have a terms of a deal or terms of a business arrangement, you're saying what exactly are we charging, what are the prices, and what are we getting. So essentially that's all that's going on with this discussion. One thing that people get confused on is they tend to confuse terms of trade with balance of payments. Maybe because they both come kind of at the same time in the course and both have the word of in them. I'm not real sure. They are similar in that both are concerned with trade between your country and the rest of the world. However, they're not the exact same because, well, balance of payments is just that. It's a balance. So it says how much trade you're doing with the rest of the world. And terms of trade is really more about the value of your goods versus the value of the goods that you bring in from the rest of the world. So the formula, it's just an index number, and what you start off with is a weighted index of export prices. Again, in this case, weighted means that you're going to give some products a higher value than other products. So, you're probably going to weight something like oil prices relatively high if you're a country that imports a lot of oil. So if you're a country that imports a lot of machinery, or if you're a country that imports a lot of food, maybe those kind of items would make up or would get a higher weight in your terms of trade. So both the export prices and the import prices are weighted, and then the export prices are divided by the import prices. So in the first year, the index year is always going to start at 100. So if in the second or the third year the terms of trade comes out to be higher than 100, what that means is that your export prices have gotten larger than your import prices. In other words, your basket of goods is getting a larger basket of goods in return. The terms we use, when they're greater than 100, we would call that improving terms of trade. And when they're less than 100, we would call that deteriorating terms of trade. But this is one of those things that you got to be careful of, because really it can be either good or bad. Just because your terms of trade is improving doesn't necessarily mean that it's a good thing for your country. Okay, to make a quick example of why this is true, let's consider South African gold exports. Do keep in mind that this is only demand from the world. So, if the price of gold, exported gold, goes up, well, all that's going to mean in terms of trade is that your terms of trade, your export number, is going to improve. Therefore, if that was the only thing we're going to change, we would see a general improvement in the terms of trade. The effect on the balance of payments, so keep in mind here now we're talking about revenue, revenue in versus revenue out. The effect on the revenue here, as we kind of already discussed before, is going to be negative. If in fact we're looking at the elastic portion of the demand curve for gold. So the price is going to go up, and that's going to result in an improvement of the terms of trade, but it's actually going to result in the current account moving more towards deficit, because the revenue here, you're going to give up A to get C, and we can see that A is bigger than C. So this is going to result in decreased revenue from exports. So we want to make sure that we don't confuse improving and deteriorating with good or bad. Okay, let's look at a quick example of how this is going to work out. So in year one, we take our two indexes and we start them at 100. So obviously your terms of trade in the first year are going to be 100. In year two, we see the index of average export prices has gone up, while the index of average import prices has stayed the same. Now remember, keep in mind these are both indexes to start with. That's making an index from two other indices. So that's why they're always going to start at 100 in the base year. So this one's risen to 102. That stayed the same at 100, which means our terms of trade have improved up to 102. In the next year, again, you take the index from the current year And in this case, it's gone from 100 to 104, and the index from the current year 106, and we divide 106 by 104, and here we see that while the terms of trade is still greater than 100, in this case it's worse than the previous, so the terms of trade have in fact deteriorated. Anyway, in that fashion we go on all the way through here. Okay, see if you can do year 6 on your own. So you should figure out both columns and then say whether or not that is improvement or deterioration of the terms of trade. Okay, so you should have set it up like this, 106 divided by 108. That comes out to 0.9814 something, rounds to 0.9815, and the new terms of trade would be 98.15. So if the new ones are 98.15 and the old ones were 101.89, this means that there has been a deterioration in the terms of trade. Okay, so then as far as like what that means, again, all we're saying is your basket of goods, if you were to take, a truck full or a ship full of the stuff that your country makes, it's talking about how much of what you can buy from other countries. So when there's a deterioration of your terms of trade, it means your basket of goods buys less than the other country's basket of goods. That may or may not have an effect on the current account, as we already said. I guess it will have an effect. We just can't always say what the effect will be. It's going to depend on the elasticity of the various goods. The reason that you might see changes in the terms of trade, we'll look at short and long run changes. In the short run, we're just, again, changes in demand and supply. So in the market that's producing those goods, so again for South African gold, we could see the price of South African gold changing because of supply factors such as labor. We could also see that maybe South Africans start demanding more of their own gold. Maybe South Africans start to buy up more South African gold, so the price of gold in South Africa increases, therefore the export price increases. Again, inflation rates, maybe there's inflation happening in one country but not the other, so that's why it's relative inflation rates. Obviously, if the inflation rates are happening the same between two countries, then that wouldn't matter. But of course, that's never going to happen. Inflation always happens sort of on its own in a given country. Again, changes in exchange rates, like we've already talked about. In the long run, you can see if there's income changes amongst export partners. So again, for China, they're affected by the income changes in the U.S. So if Americans have more money to spend in general, they're going to demand more of Chinese products, therefore the price of Chinese products is going to come up. Productivity is a big one as well. Obviously, if you can be more productive, if you can be more efficient, the price of your exports is going to go down, or vice versa if your trading partners become more efficient.